Hello, welcome back to UK Money Wisdom and to video 2 in the series explaining pension tax rules. Because pension tax shouldn't feel overwhelming, so in this series we make it simple, and we're dealing in each video with 4 real scenarios that will save you pounds. And we use the same 4 scenario format every time. A simple case, a moderate case, a mixed income case, and a non-standard trap case. And all of it follows HMRC's real income order, because that order controls your tax code, your allowances, and whether you need a self-assessment return. Here's the income order: state pension, other pensions, earnings, savings interest, dividends, capital gains, foreign income. Once you see income in that order, everything becomes clearer. Let's jump in. The first is a simple case. Elsie, aged 80. Elsie gets the basic state pension plus PIP mobility at the enhanced rate. Elsie receives the old basic state pension at £176.45 a week, which comes to £9,175 a year. She also receives £150 of savings interest and gets PIP mobility enhanced rate at £77.05 a week, which is completely non-taxable. Here's her tax position. Total taxable income, £9,325. That's below the personal allowances of £12,570. Her £150 of interest sits inside the £1,000 savings allowance, and PIP is ignored for tax purposes. So the outcome? No income tax, no tax code, no self-assessment, and the key learning tip here: PIP benefits do not affect tax in any way. The second scenario, our moderate case, looks at Brian, age 72. Now, Brian has a part-year new state pension plus a private pension, and Brian receives £10,180 of new state pension because he only had it for part of the year. The new state pension is £230.25 a week, or £11,973 a year. And this is where HMRC often go wrong. They frequently assume everyone gets the full year amount, you see, even when you start part-way through. And when that happens, they shrink your tax code and you get overtaxed on your private pension. Brian also receives a £7,000 private pension and £300 of savings interest. Total income, £17,480. Tax is due overall, but Brian will almost certainly overpay unless he corrects the HMRC forecast. And the fix for this? Brian must check the actual pension figure on Government Gateway, ask HMRC to correct the code, or file a self-assessment return. And the key learning point? Part-year state pensions are one of the biggest causes of incorrect tax codes, so do pay attention if that scenario is happening to you. Scenario number 3 is the mixed income case. Alex and Pat are both 69, different state pensions and rental property gain here, because Alex receives the full new state pension at £11,973, a £4,000 private pension, £300 savings interest, and an £8,000 share of a capital gain. Now, Pat receives a reduced new state pension at £9,600 because of years spent contracted out. They also have £200 savings interest and the same £8,000 capital gain. The rental property produced a total gain of £16,000, split 50-50. The capital gains tax annual exempt amount for 2025-26 is £3,000 each, which means each person has £5,000 of taxable gains. Here's the key thing couples often miss. Capital gains tax is individual. You have two people here, two allowances, two gains, and two potential tax returns. And the outcome? Alex likely needs self-assessment. Pat may also need self-assessment, even with no income tax due, because of the gain alone. And the key learning point? Joint property equals two taxpayers, not one. And finally, scenario number 4, the non-standard trap case. Here we have Margaret, age 70. She has a deferred new state pension plus part-time work. Margaret deferred her pension for 2 years. Her base pension is £11,973, and deferring by 2 years increases it by roughly 11 to 12%, giving her about £13,350 a year. She also has £3,000 workplace pension, £4,500 earnings, £600 savings interest, total income £21,450. Now the state pension uses most of the £12,570 personal allowance. So the PAYE then collects tax from her wages and workplace pension. And her £600 interest sits well inside the £1,000 savings allowance. Here's the trap though. Deferring increases your taxable income, not your tax-free allowance. So if you're still working when you take the boosted pension, HMRC squeezes the tax codes and the tax bill rises. So the outcome? Tax due through PAYE, self-assessment not automatic, but a code check is essential. Key learning: deferral can be powerful, but the higher income is still fully taxable. Once you understand HMRC's income order, everything does get simpler. You can read your tax code, predict your tax bill, stop overpayments, spot HMRC forecast errors instantly, and know when a self-assessment is required. In the next episode, we'll look at 4 more real viewer cases, shall we? Including the most common overpayment traps. I've given you all UK tax details matching the 2025-26 rules as we hold them. And of course, it's general guidance only, based on current UK tax rules and public statements for 2025-26. If you found this useful, follow for the next video in the series by subscribing, and do share with someone you care about who could well use this help. I'm Angie, and this is UK Money Wisdom, and I'll be back very soon. Bye for now. Have a good day.